Hey, Dr. Paul here. Just wanted to share with you one of the common questions I get is what do you do with the bookkeeping, especially with a new practice? But this is what you need to be aware of with bookkeeping, a few major points for your practice. Number one is you definitely want to use a bookkeeper. You do not want to keep your books and you want them professionally done. You want a bookkeeper and they'll take care of your payroll, your bills, things of that nature. Make sure you never allow your bookkeeper to sign off on your account. You're the only one that can sign off on your account. Number two, keep your bookkeeper separate from a CPA. You definitely want to use a CPA for your year end. You do not want to use a CPA for your quarterlies, okay? Your year end. And the reason you want them separate, well, the reason you want to use a CPA is a couple of reasons. They're going to be a little more knowledgeable about deducting your ledger, but you're not responsible for mistakes if your CPA filled out your tax forms, whereas if you filled them out, you're criminally liable for them. So that's the main reason you want to use the CPA, to be honest with you. Now, what else you need to know about the CPA is they're good at the books, whatever the books are, deducting your ledger. That's not where most doctors have the benefit of knowing taxes. In other words, you have to know the basics of tax deductions and all the categories. So if you kind of look at it like this, there's the ledger portion. Well, that's kind of easy for the most part, what's deducted, et cetera. That's what you'll essentially be handing over to your from your bookkeeper to your accountant. So the rest of it's earned income. And what you need to be aware of is there's about 80% of that is tax deductible if you knew the tax laws or the basic tax strategies. And of course, we teach that in our course. We have the tax course, we teach that in. And if you don't, then you're going to be liable for 100% of that earned income. And most small business owners are routinely doing what they need to do to a large degree to make that other part. Now, remember, talking about the other part, the earned income that the accountant did not see, because you actually have to tell the accountant what's deductible or not. They're just going to look at your ledger. So that means they're going to give you your earned income. Well, you have to know, and you're the one that has to tell your accountant and give the accountant the receipts and the documentation necessary to write off that component, so it's not it's not considered earned income. And I've just found working with chiropractors, especially small businesses, we're constantly focusing on our business. There is no such thing as 9 to 5 when you're self-employed. And so, if you just knew some of these other basic things that you need to do, I'll give you a simple example. Let's say that there was 5 categories that had to be done to make that tax deductible. And a lot of times the chiropractor is doing 4 of them. Well, all he has to do is the 5th one, and now it's tax deductible, see? And you're the one that needs to know that to give it to your accountant, because your accountant will not know it. They will only know the ledger. So this is where you will save a lot of money. That's there. Okay. Next, you do not want to use your accountant's bookkeeper for 2 reasons. One, you're just going to be paying more. Okay. That's just another built-in cost. But now you have 2, if you use a separate bookkeeper from your accountant, you have 2 separate eyes looking at your books. And that's what you want. You want 2 separate eyes looking at your books. So what you want is a bookkeeper, and a bookkeeper is going to be way less expensive to do the your bills and your quarterly and your monthly bills, things like that, and your biweekly payroll. They're going to be way less expensive than you hiring an accountant for year-round taking care of, because all they're going to do is hand it over to their bookkeeper, and then they're going to tack on the extra for themselves. That's what they're going to do. So you want a separate bookkeeper, and then to do all your payroll, your monthly bills, your quarterly statements, and then the bookkeeper hands over all the documents to the accountant at the end of the year. And then you also hand over your documents that you learn how to make tax deductible your expenditures legally. That's what you want to do. Then the accountant does an annual. And now you have 2 eyes on your books. And that's the most effective, efficient way. And the last thing you just need to be aware of is when you, and this is true of all businesses, never use a business that's been in business for less than 5 years. And the reason is 8 out of 11 businesses go under in the first 5 years. So don't get yourself involved with somebody who's only been in business 1, 2, or 3 years. And that reason, but also that's when they know the least amount. They don't have much experience and they know the least. So you want to stay away from new businesses. Now, there's 4 stages of a business. In the beginning, they're essentially they're starting. So you want to kind of stay away from that. And then they're starting to grow. And that's when they start charging more and they're trying to get clients. And then they kind of hit the 3rd stage, which is maturity. That's when they're at the peak. They're running full speed, charging full prices, have full staff. That's when you're going to pay the most. And the best place is the 4th stage of a business, when they kind of are past the peak and they've been in business over 30 years. They've made a good amount of money and they're just kind of relaxing. And a lot of times the main player is working part-time now even. That's when you'll get the best experience at the lowest rate if you catch that business in that region. And that's how that works. So that's what you want to do with your bookkeeping. Use a bookkeeper. And then where do you get them? The resources? Well, obviously referrals good, but check your local chamber of commerce, your Rotary clubs. That's where you want to find, and also the Better Business Bureau. That's where you can, if you don't have a referral, that's where you want to go. And you want a mom and pop. An owner-operated business. You do not want a franchise or that's employee-based and the owner's not even on site or paying attention to it. That's when you're going to get the worst service and the worst product, essentially. So these are some major keys of picking a business. So you want your bookkeeper separate from your accountant. Use your accountant only once a year. Have your bookkeeper do the pay bi-weekly employee statements, monthly bills, quarterly statements. You make sure you know the basics of taxes so that earned income your accountant does not deduct. You can tell him that he needs to deduct this, and that, and you have the documentation to support it. And I'll just tell you, that's gonna save you about $50,000. That alone will save you $50,000. And then that's how you get the referral source from your local Better Business Bureau, Chamber of Commerce, Rotary, and make sure it's a mom and pop, not a franchise. And if you can catch them in their later years, that's when they have the most experience, they're the best at it, and they don't charge as much. They're just real stable is what they do. So anyway, take that for your consideration, but that's exactly how you want to set up your bookkeeping. And you also want to have your credit cards totally separate. You never want to mix your business expenses with your personal expenses. So you'd have your ledger and your checks, then you'd have your credit card only for business expenses. And then what I would even suggest is even have another credit card for what I call the earned income business expenses or other business expenses, because you'll be able to deduct many more types of expenses, especially when you're in a program like mine, where you hire associate doctors and you invest in real estate, as opposed to just being a chiropractor. You're just limited to that if that's all you do with deductions. But when you do all these other things, it opens up a lot more windows for legitimate deductions. So that's what you want to be aware of is then you take those, give them to the accountant, give them to your CPA. That's how you want to handle that. All right. Hope that was, and then anyway, back to so you got the business, you got your ledger, your checks, you got your business credit card, you got your personal business credit card. So it's the earned income that's not on the ledger that you're going to deduct, and all these other potential business expenses you can deduct that's not necessarily related to chiropractic, but it's legitimate. And we teach how that works. And then and then have just your personal credit card, and then there's cash. That's the dynamics of how it works. Hope that helps you out, but that's how you want to structure your bookkeeping.